Okay, let's mark the 15,000 level on the chart, and that would be further 7% fall from the current level. Let's drag it further below. In the worst case scenario, if at all Nifty loses its 15,000 level, it would be around 12% fall from the current level of Nifty. Hello everyone, welcome to today's video. Today we are going to discuss one of the leading FMEG company in India, that is Havells. Havells is based in Noida, and today Havells is one of the most trusted name in India in consumer durables. This video will be divided into three segments. First, we are going to talk about the company and their products, margins, revenues, etc. And then we look into some of the financial data of the company. And finally, we'll see the price chart and we'll discuss if this is the right time to buy this stock. The company was established in 1958, and then it was just a switchgear company, and later they evolved as a company and grow their business in different segments and constantly introduce new products. And today Havells is a global brand with their footprints in more than 60 countries, and they also have a very strong dealer networks. And Havells also owns the brands like Lloyd, Crabtree, etc. Let's see what are the products they have in their portfolio. They have fans, home appliances, kitchen appliances. Recently they have launched personal grooming products, and also obviously they have switch gears and wires and cables, etc. Under Lloyd, they are selling white goods such as air conditioners, refrigerators, washing machines, etc. If you see the segment-wise revenue, maximum of the revenue comes from wires and cables, that is 30.4%, followed by electrical consumer durables, that is 22%, and Lloyd business contribute to 16% of their revenue. Now let's see what are the opportunities and the risks for the companies like Havells. See, India is the second largest population in the world. So there will be ever-growing need for the appliances like kitchen appliances, home appliances, etc. And the second fact that I would like to tell you, the AC penetration in India is only about 8%, and refrigerator is 33%, and washing machine is 16%. Don't you think these numbers will increase in the future? Definitely yes. As the per capita income of Indians increases, the consumer demand will also increase. Now let's see some of the risks. One that we have just witnessed is the pandemic. See, in pandemic situations, consumer sentiment will affect the companies like Havells because people will not spend money. Another common threat is the inflation. The rising input cost materials will impact the margins of the company. The companies like Havells will deal with this. They will pass on the input cost pressure to the customers. They will raise their product prices in order to offset the margin pressure. Any challenges are not permanent. There will be short-term pressure on the companies, but the outlook is very encouraging and promising. Now we'll quickly look into some of the financial numbers. The stock is trading at a PE of 65 against the sector PE of 63. We will see why this stock is enjoying premium valuation, whether this PE is justified or not. Okay, I think we can see the data in screener.in. I think it's already open in other window. The market cap of the company is 67,000 crore, so which is a large cap company. Havells is almost a debt-free company. You can see the debt is it's only 0.08, and you can see it has a decent inventory turnover ratio of almost 3. That means in an year, company has replaced its inventory 3 times. So that says the company's sales numbers are good. The best thing is company is able to generate free cash flow. For any company, this is very important, and we'll discuss this in detail when we see the cash flow statement. Let us see the annual numbers. If you see, the sales numbers were 5,000 in March 2010, and it has been reached to 10,000 in March 21. So there is no doubt that company is increasing its revenue year on year. And the best part is, initial years, the OPM, the operating margin, was very less, and see the improvement in their margins. That tells how efficiently company is managing their expenses, and also how they are upkeeping their margins in times of high inflations, pandemic, or any situations like that. Look at the net profit growth that has been grown from 70 crore to 1044 crores. That's really impressive. See the earning per share for the last 4 to 5 years. It has been increasing every single year. So we have spoken about PE, why the market has given so high PE for this stock, and this is the reason for that. I have made a separate video on PE and EPS of a stock. You can check out the link in the description, as well as I'll put the link on your screen. See the ROE. Company is efficiently using its shareholders' capital to generate the profit. You can see the company has reduced its borrowings. It is important to see whether the company is able to generate free cash flow or not. Cash flow statement is a different subject altogether to make a video on. I will definitely do that, but for today our focus is only on the free cash flow. Free cash flow is nothing but the amount that is retained after deducting the capital expenditures from the cash generated from the operations. Now the capital expenditures are nothing but the investment that is made by the company on the plant, machineries, equipments, vehicles, land, etc. So it is very important for a company to have a positive free cash flow, so that they can utilize that amount to repay the borrowings or paying the dividends, etc. Otherwise, if the company doesn't have a free cash flow, then they have to go for the fresh borrowings again. That would be a burden on the company. You can see the list of fixed assets and the amount that has been spent on the fixed assets in the balance sheet. The cash conversion cycle of Havells, it's really impressive as compared to peers. I have made a separate video on cash conversion cycle. I will provide the links in the description. You can watch later, and also I will provide the link on your screen as well. Havells ROC is also very good, and why ROC is very important, because the borrowed money is also accounted for in this ratio. It is the total capital employed in the business. It tells us about how efficiently companies are using its capital to generate profit. The stock is currently trading below its 200 moving average, and the price has fallen roughly from its peak. It's 28%, and it's nearing its key level. Let's draw the key level for you. Let me tell you, I am a buyer on this stock, considering its financial status and the past performance and the future outlook for this company. Everything is good. Important is how you are planning your buying. For those of you interested in this stock, I would recommend a price to reach this key level, and at this key level you can consider buying 50% of the quantity, and then you have to wait for the reversal chart pattern to form, preferably double bottom. And also there are chances that stock, given the current scenarios, ongoing war between Russia and Ukraine, we don't know how the situation will shape up in the future. There are chances that price may further slip beyond this key level. Let us see if there are any other key levels. Let me draw a Fibo retracement from bottom to top, and let me delete all these unwanted levels. I prefer only 0.5 and 0.680. Let me draw one horizontal line at 0.618. See how beautifully 0.5 level is aligned with our key level. I think 618 is also aligned with the next structure level. If the price couldn't hold on to the first key level, then I will wait for the price to reach to the 618 level. Now that is the next Fibo level or the next structure level. Then I will add all my remaining quantity there, and I will stay peacefully, and I will wait for my target. I don't want to define the target because different people might have different targets. But one advice I can give you for the people who are of the very short term view, can avoid investing in any of the stocks given the current market scenario. I will give you another logical reasoning. Let's see the Nifty chart. See, Nifty is also trading below its 200 DMA, and it has fallen roughly 12 to 13% from its peak. And we saw that Havells stock has fallen from its peak roughly 26 to 27%. That means every 1% fall in Nifty, there was a 2%, approximately 2% fall in Havells. Let's assume Nifty will fall to 15,000 level, and I don't think Nifty will fall below 15,000. Okay, let's mark the 15,000 level on the chart, and that would be further 7% fall from the current level. Let's drag it further below. In the worst case scenario, if at all Nifty loses its 15,000 level, it would be around 12% fall from the current level of Nifty. Logically speaking, a 12% fall in Nifty could result in 24% fall in Havells. Let's see the Havells chart. Let's see how much is the 24% fall in Havells from the current level. See, this is almost close to our 618 level. According to me, in either ways, the best buying level would be the first 50% at the first key level, and the remaining 50% near the 0.618 level if the stock corrects further. If you like the video and the analysis, please show your support through your likes and subscriptions. I will keep posting this kind of analysis videos. Thank you for watching.